So, picture this. You own a stock, and you get a notice about some corporate action. It sounds technical, maybe a little boring, but, harmless. But what if that seemingly neutral event is actually the single biggest red flag a company can possibly raise? What if it's the final warning shot right before the value of your investment completely collapses? To really get why this is such a big deal, we first have to look at what I like to call the accounting mirage. Because on paper, a reverse stock split seems like nothing more than simple, clean math, just a little financial housekeeping. Okay, so on the surface, the mechanics are super straightforward. Let's say you have 1,000 shares, and they're trading at $1 each. Your holding is worth $1,000. The company does a 1-for-10 reverse split. Now you've got 100 shares, but they're trading at $10 each. Your total value? Still $1,000. Nothing's really changed, right? It just looks like an accounting trick. But that's where the illusion just shatters. While the math itself is neutral, the market's perception is absolutely brutal. A reverse stock split is almost never an act of strength. It's a maneuver of pure desperation. This is not some neutral event. It's a signal of deep systemic trouble. So you gotta ask, why would any company make such a desperate move? Well, it's not about tidying up the numbers, it's about a fight for survival. But what's the actual point of artificially juicing up the price like this? The answer lies in the rules set by the major stock exchanges. And these rules can mean life or death for a public company. See, this is the pressure cooker a company finds itself in. If its stock is sinking below $1 for a whole month, the exchange puts it on the clock. It gets 180 days, a grace period, to get its act together. And if it can't, well, it faces a stark choice. Either engineer a higher price with a reverse split or get kicked off the exchange entirely. And getting kicked off? It's a total disaster. On one side, you have the big leagues, the NYSE, the NASDAQ. We're talking prestige, oceans of liquidity, and access to huge institutional money. On the other side, you've got the OTC markets, which is kind of the Wild West of finance. Liquidity dries up, and most of those big funds won't, or just flat out can't, touch your stock. So at the end of the day, a reverse split isn't a cure. It's just financial cosmetic surgery. The company is basically slapping a fresh coat of paint on a crumbling foundation, all while hoping investors won't notice the deep structural rot right underneath. But honestly, the mechanics are only half the story here. The real damage, it's psychological. It's all about the powerful negative signal this sends to the entire market, a signal that can literally trigger a complete collapse. I mean, think about it. The people who know the absolute most about a company, its own management, are effectively standing up and telling the world, we have no faith that our business can get our stock price back above $1 on its own. It's just a stunning admission of failure. And this admission of failure, it just triggers a massive chain reaction. Short sellers, they smell blood in the water. They see an artificially inflated price that's just begging to fall again. Institutional investors? Alarms go off and they quietly start heading for the exits. And even the retail speculators who loved the stock as a cheap bet, they lose interest because that lottery ticket appeal is just gone. But if all that wasn't bad enough, a reverse split can unlock something way, way more destructive, something called death spiral financing. This is when things get really ugly. Struggling companies take on toxic debt that can be converted into stock at a huge discount, setting the stage for a total wipeout. And this creates a truly vicious cycle. The lenders convert their debt to stock and immediately dump it on the market, crashing the price. The company is then forced to do a reverse split just to stay listed, which only resets the price higher. And this gives the lenders a brand new, higher starting point to dump even more shares. It's a devastating loop: split, dilute, crash, and then repeat it all over again. And the result of this cycle? Total annihilation of shareholder value. And look, it is not an exaggeration to say that this process can, and very often does, wipe out 99.9% of a stock's value. It leaves the original investors with practically nothing. Okay, so is a reverse split always a death sentence? Well, not quite, but the exceptions, the ones that show signs of life, they are incredibly rare, and they only happen under very, very specific circumstances. The classic example of a strategic, good split is Citigroup after the 2008 financial crisis. Now, that was a fundamentally stable institution that got hit by a massive, once-in-a-generation shock. The split was part of a real, verifiable turnaround plan, not some desperate attempt to hide a failing business.
But here's the thing. For every one Citigroup, there are hundreds of other companies in that first column, just using a split to disguise a business that's fundamentally broken.
So, what does this all mean for you? Let's turn all this knowledge into a practical playbook so you can protect your own investments. First off, let's just look at the cold hard data. Academic studies are crystal clear on this. On average, stocks that do a reverse split significantly underperform the broader market in the year that follows. The numbers just don't lie. So this leads us to a simple 3-rule playbook. 1. Audit the history. Before you even think about buying, check if the company has done multiple reverse splits in the past. If you see a pattern, that's a huge red flag. 2. Monitor the clock. If a stock you own gets a delisting notice, remember that the selling often starts before the split even happens. And 3. Ignore the cheapness fallacy. A reverse split just changes the price tag. It doesn't change the quality of the business underneath.
And that really is the key takeaway here. A reverse stock split isn't some complex financial event that you need to analyze for some hidden opportunity. No, it's a simple, loud, and clear signal. It is the company's final warning flare before the ship goes down.
So we'll just leave you with this question to think about. When a company's focus shifts away from actually creating value to just engineering its stock price, you really have to ask yourself, are you still an investor in a growing business, or have you just become the exit liquidity for everyone else who already saw the writing on the wall?